So throughout this course, we've talked about how consumers make decisions. We know they make decisions at the margin. We know that if their willingness to pay is greater than the price, then they buy. And if you remember from one of the very first lectures, their willingness to pay, for the most part, is governed by their preferences. So there's no notation here. I'm saying willingness to pay is a function of their preferences. And that's kind of where the analysis stops, right? There's not really much more to analyze because people just have different preferences. However, we haven't talked much about producer decisions. So in this video, we want to dive into what things govern the firm's decisions and their other behavior. So we'll quickly revisit something we stated in one of the very first lectures, and that's that any firm's goal is to maximize profit. And recall that profit is total revenue minus total cost. And total revenue, of course, is the amount a firm receives from the sale of its output, which is usually price times the quantity sold. And the total cost is going to be the value of the inputs the firm uses to produce those outputs. So first, let's look at what contributes to the total cost. So cost can be split into explicit and implicit costs. So explicit costs are things that you traditionally think of as costs, or things that require an outlay of money. Things like paying workers, buying raw material, whereas implicit costs don't require a cash outlay. Things like the opportunity cost of the owner's time. And I'll be clear here, explicit and implicit costs are both opportunity costs. Just because one requires a transfer of money and one doesn't make any difference. They're both opportunity costs. So I'll write this down to reiterate, but opportunity costs consist of both the explicit and implicit costs. So we can also categorize profit in a similar way. There's what's called accounting profit and economic profit. Accounting profit is going to be total revenue minus total explicit costs, and contrast that to economic profit, which is going to be total revenue minus total costs, meaning implicit and explicit. So accounting profit ignores the implicit costs. So accounting profit is always going to be higher than economic profit. So accounting profit is going to be what you think about in the real world. As in, if you read a financial report from a publicly traded company, they're going to be reporting accounting profit, not economic profit. When Amazon reports its quarterly profits, they're not reporting the opportunity cost of Jeff Bezos' time. However, the decisions that Amazon makes are dependent on the value of Jeff Bezos' time. He's going to run the company differently based on his opportunity cost. So it is important to consider economic profit when you're trying to explain the behavior of a firm. So the next term we need to define is what's called the production function. And the production function is going to represent the relationship between the amount of inputs used for production and the amount of output you get during production. This is going to be very similar to the demand or supply schedule we looked at before, meaning we can represent it with a table or an equation or a graph. So let's look at an example. Let's say we have a farm and we have labor. We'll call that L. This is going to be the number of workers. And our output, Q, which we'll say is bushels of wheat. So in the table form, the production function is just going to equate an output value with each value of labor. So if we have no workers, we get no output. We'll say one worker can generate 1,000 bushels of wheat, and so on. We can fill this out for some hypothetical values. So this is in table form, but we can also graph this. And we plot this just like any other table we've plotted in the past. We've got 0, 0, 1, 1,000, 2 and 1,800, 3 and 2,400, 4 and 2,800, and 5 and 3,000. So this line is our production function, and it relates any amount of labor to output. So obviously, there's no such thing as 1.5 workers, but if we had some other input here, we could find what our theoretical output would be based on that amount of input. So we'd like to have some language or some tools to analyze production functions of different firms, and we can do that, but we have to define yet another term. This one's going to be marginal product. And the marginal product is going to be it's the amount that output increases if you add an additional unit of input without changing anything else. So quick note on notation. Marginal product, we'll abbreviate that MP, is going to be defined as the change in quantity divided by the change in the input. In this case, it's labor. And remember, the Greek delta just means change in. And so in this case, our input is labor. So this is actually the marginal product of labor. We'll put that little subscript L there. So now let's look at the marginal product of labor from our example on the previous slide. So here's the values that were on our table from last time. So with 0 workers, we have 0 output. Our change in labor is 0 because we didn't increase. It doesn't make sense to talk about an increase from 0. Our change in quantity was also 0, and we really have nothing to compare this first line for, so the marginal product of labor is not really applicable. But when we add one worker, we want to look at the change from going from 0 to 1. So our delta L is 1. We added one worker. Our delta Q, our change in the number of bushels, is the difference between 0 and 1,000. So 1,000. And our marginal product of labor is delta Q over delta L, which is 1,000 over 1, so 1,000. So then going to the next rows, in every case, we're adding one worker at a time. And then we can calculate the delta Qs. So in the second value, we're looking at the difference between 1,800 and 1,000. So it goes 800, then 600, 400, and 200. And since delta L is 1 in all of these cases, our marginal product of labor is going to be equal to the change in quantity. So now we'd like to know, how does the marginal product of labor relate to our production function? Well, if we go back and look at our production function, the marginal product of labor is going to be the slope of the production function. So we can demonstrate this. Let's take 2 points, 2 to 3, and we want to calculate the slope between these 2 points, which means we need the rise over the run. The run is going to be one worker, and then our rise is going to be the difference between 1,800 and 2,400, or 600. And so if we calculate our slope, which is our rise over run, we get 600, which is exactly what we got for the marginal product of labor in a change from 2 to 3. So another question you might have is, why does the marginal product of labor matter? Well, each additional worker adds to the cost of the firm. You have to pay them wages. So knowing how much they're going to produce helps you decide whether to hire them or not. So let's look at the first and second workers. Let's say a bushel of wheat costs $10. So the second worker has a marginal product of labor of 800. And if that product sells for $10 per bushel, then the second worker's revenue, or the revenue generated by that worker, is going to be 800 times the $10 per bushel, or 8,000. So this value is the maximum that the firm is willing to pay that worker. If they pay them any more than this, then they're not going to generate any profit from that hiring that worker. So there's one other property we want to highlight with the marginal product of labor, and that is that it's decreasing with each additional worker, or diminishing. And this is a standard property of the production function, meaning that each additional worker contributes less than the worker before. And to see the logic, I think it's best to imagine an absurd scenario. Say there were 100,000 workers all trying to pick wheat. They'd be bumping into each other. It would be difficult to move around, and they wouldn't be very effective. So on the smaller scale, that still happens. It's just not as obvious. So the farm example with wheat, the reason for diminishing productivity of labor is maybe not as obvious. I'll give you one more example. So imagine a grocery store. Here's the checkout lines. This is a cashier, and someone else is here working bagging groceries, and there's a long line of customers everywhere. So if there's only two people working, there's going to be a long line of people waiting to check out, and you can increase the number of customers you can service by adding an additional worker. So if we add one more over here, now people can come to this register. And if we add another, we can get someone bagging groceries on this register, and we can do this for the third register. So up to 6 people, we're increasing the efficiency that the grocery store is operating and checking people out. But once you add a seventh person, it's not really clear if they're going to increase efficiency. So maybe we add another person here bagging groceries, and that might increase some efficiency, but putting the groceries in bags is probably not the bottleneck. And so let's say we keep adding people. And then if we take it to an absurd level, let's say there's 6 people all right here bagging groceries, and 4 people over here trying to help the cashier. It's not really obvious what all those people would do to increase efficiency. I would say maybe 2 people bagging groceries is about all you need. Once you get more than that, I'm not really sure those 4 people can help much. And so that's why, as you keep adding more and more people, your efficiency per person decreases eventually. But you'll notice when we began adding labor, it's pretty obvious to see that adding more people when there were only 2 working was increasing efficiency. So that brings up a point. Our production function we looked at before looked like this, and it was increasing, but at a decreasing rate. So every time we added labor, quantity increased, but the slope at each point gets more shallow. But that's not the only type of production function you can have. You could also have a production function that looks like maybe something like this. So in this section of the production function, we're increasing at an increasing rate. And then once we hit this point, this section, we start increasing at a decreasing rate. So in this section, in our grocery store example, this is adding cashiers to registers, which means we can service more customers. And maybe up here, this is adding the 5th bagger to a register, and they're not really contributing that much to total number of customers that the grocery store can service. So another way to say increasing at increasing rate in this context is increasing marginal productivity of labor. And then once we pass this inflection point here, we have decreasing marginal productivity of labor. So your production function can have increasing marginal product of labor, but eventually you'll always have decreasing marginal product at some point eventually. So now I want to talk about how the addition of labor influences the total cost. So we have our same example. We've got our number of workers, the corresponding bushels of wheat produced, and now we've added this extra column, cost of land, because total cost is not just the cost of labor, it's also the cost of any equipment or capital you're using. So let's say the cost of land is $1,000. And that doesn't change based on how many workers you add. It's always $1,000. So when you have 0 workers, your cost of labor is $0, but you still have a positive total cost because you have that capital that you're paying for. And then when we add a worker, we still have that cost of the land, but now we have a wage to pay them. Let's say we pay them $2,000. So now total cost is 3,000, and we can do this for each worker. Like everything in this class, we can plot it on a graph. So when we graph this, what we get, the line is called the total cost curve. And this just represents the relationship between the amount of production and the total cost for that production. And so like everything else we've plotted, the slope of what we plot has meaning too. And so the slope of total cost is what we call marginal cost. Marginal cost is going to be defined as the increase in total cost from producing one more unit. And for the sake of calculating marginal cost, we define it as the change in total cost divided by the change in quantity. So let's look back at our example again. We can calculate this. Again, the first entry, it's not really applicable because we have 0 output and labor. But once we go from 0 workers to 1 worker, our change in quantity is 1,000 bushels. Our change in total cost is 1,000 to 3,000, or 2,000. And so our marginal cost is the change in total cost divided by the change in quantity, or $2. And we can do this for each subsequent addition of labor. And you'll notice that the marginal cost for each additional worker is increasing. And that's because our marginal product of labor is increasing. So each additional worker adds the same amount to total cost, but they contribute subsequently less output as we get more workers. And so our marginal cost increases as we add more workers. And once again, we'll plot marginal cost. And what we get is what we call the marginal cost curve. And notice that the curve slopes upward, or increases at an increasing rate. And this is a general property of the marginal cost curve because of the marginal product of labor decreasing. So why is the marginal cost curve important? Well, the firm wants to maximize profit, and recall that people think on the margin or make decisions on the margin. So when, let's say you're farming here and you want to make some production decisions, you want to know that the additional unit of output you're producing is going to cover the cost generated by that unit of output. So we know that at 3,000 bushels of wheat, the marginal cost is $10 per bushel. That means that that bushel of wheat, the 3,000th bushel of wheat, needs to be sold for at least $10 for it to be worth it, because we know it costs $10 to generate that bushel of wheat. So we can summarize this by saying that the revenue from the marginal unit of output has to be greater than that same unit's marginal cost. Otherwise, that unit won't be produced. If the unit you produce of output can't be sold for more than it costs to make it, then it doesn't make any sense to make it. So this is already running long. We'll go ahead and stop this video, and in the next one, we'll talk about fixed versus variable costs and how that relates to total cost.